So students, in last class I was discussing about economic analysis, which gives an indication about the direction of the economy and the stock market. Industry analysis is also required because the return and risk level of the industries will differ. The risk factors related to the automobile industry would be different from that of the information technology industry. Consumer spending have a great impact on the automobile industry than on the IT industry. The performance of an industry reflects the performance of the companies. So, what is an industry analysis? An analysis of the performance, prospects, and problems of an industry of interest is known as industry analysis. Of interest in the sense, an investor who is interested in investing in a particular industry. So, as I told you, the return and risk level of the industry will differ. That is, the risk and return level of one industry would be different from of the another industry, and the performance of one industry would be dependent on the performance of the other industry, and so on. The performance of industry reflects the performance of the companies. It consists of, now, what is an industry? An industry is a group of firms that have a similar technological structure of production and produce similar products. For the convenience of investors, a broad classification of industries is given in financial dailies and magazines. Companies are distinctly classified to give a clear picture about their manufacturing processes and products. You also get an industry-wise classification that is given by Reserve Bank of India, India Bulletin in its website. So industries are classified into many like food products and beverages, tobacco products, textiles, clothing, apparel, dressing and dyeing of fur, luggage, handbags, etc., wood and wood products, paper and paper products, publishing, printing, and reproduction of recorded media, coke, refined petroleum products, and nuclear fuel, motor vehicles, trailers and semi trailers, transport equipment, furniture, manufacturing, rubber and plastic. There are many classification of industries, but there are some kind of classification which is based on business cycle like growth industry, cyclical industry, defensive industry, cyclical growth industry. What is growth industry? It has a special features of high rate of earnings and growth in expansion interdependent of the business cycle. The expansion of the industry depends mainly on technological change. For example, despite the recession in the global economy, there was a spurt in the growth of the alternative energy industry during the year 2011-12. That is, there was a growth defying the business cycle and it continued to grow. Similarly, in each phase of history, Certain industries like color televisions, pharmaceuticals, and telecommunication industries also have shown a remarkable growth. What are cyclical industries? So, under this classification, the growth and profitability of an industry move in tandem with the business cycle. That is, it moves in line with the business cycle. During a boom, industry enjoys growth, and during depression, they will suffer a setback. For example, white goods like fridge, washing machine, kitchen range products, they command a good markets during boom, while demand for those will slackens during a recession. Defensive industries also will defy the movement of the business cycle. For example, food and shelter satisfy basic human needs. The food industry withstands recession and depression. The stocks of defensive industries can be held by the investor for income earning purposes. They expand and earn income in the face of depression too, under the government's umbrella of protection, and they are counter cyclical in nature. Cyclical growth industries are those where they are a type of industry which is cyclical and at the same time they are growing. For example, automobile industry experiences periods of stagnation and decline but also grow tremendously. Changes in technology and introduction of new models will help the automobile industry to resume its growth path. You also should know about the industry life cycle. As the industry life cycle theory, it is attributed to Julius Grodensky, a professor at the Wharton School of Business. The life cycle of the industry is classified into four well defined stages, that is, pioneering stage, rapid growth stage, maturity and stabilization stage, and decline stage. Under pioneering stage, the prospective demand for the product is promising and the technology of the product is low. The demand for the product encourages many producers to produce that particular product. There is severe competition and only the fittest companies survive in this stage. The producers try to develop the brand name, they differentiate the product and create a product image, which leads to non price competition. The severe competition will lead to change of position of the firms in terms of market shares and profits. In this situation, it is difficult to select companies for investment because the survival rate will be unknown. In rapid growth stage, the companies that have withstood the competition steadily will improve their market share and financial performance. This stage starts with the appearance of surviving firms from the pioneering stage. The technology used in production will improve, resulting in low cost of production and good quality products. The companies have stable growth rate in this stage and they declare dividend to their shareholders. For investors, it is advisable to invest in the shares of these companies. The pharmaceutical industry has improved its technology and the top companies in the sector are giving dividend to their shareholders. The power and telecommunication industries also can be cited as examples of industries in this expansion stage. In this stage, the growth rate is more than the industry's average growth rate. Maturity and stabilization stage. In the stabilization stage, the growth rate tends to moderate, and the rate of growth more or less equals to industrial growth rate or the gross domestic product growth rate. Due to symptoms of obsolescence appear in technology, keep going, technological innovations in the production process and product have to be introduced. Investors must closely monitor the events that take place in the maturity stage of the industry. In declining stage, demand for the particular product and earnings of the companies in the industry will decline. Nowadays, very few consumers demand black and white televisions, or there is no demand at all for these televisions. Innovation and changes in consumer preference lead to this stage. The specific feature of the declining stage is that even in a boom, the growth of the industry is low and declines at a higher rate during a recession. And foreign investors, it is better to avoid investing in the shares of low growth industry even during a boom. Investment in the shares of these types of companies leads to the erosion of capital. Apart from industry life cycle and the type of industry, an investor must also analyze factors like growth of the industry, cost structure and profitability, nature of the product, nature of the competition, government policy, labor, research and development. The historical performance of the industry in terms of growth and profitability should be analyzed. Industry wise growth is published periodically by the Center for Monitoring Indian Economy. The past variability in return and growth in reaction to macroeconomic factors will provide an insight into the future. Even though history may not repeat in the exact manner, by looking into the past growth of the industry, an analyst can predict the future. The cost structure, that is, the proportions of fixed and variable cost, will affect the cost of production and profitability of the firm. In the case of oil and natural gas industry and iron and steel industry, the fixed cost portion is high and the gestation period is also lengthy. The higher the fixed cost component, the greater is the sales volume required to reach the firm's break-even point. Once the break-even point is reached, the production is on track. Profitability can be increased by utilizing the capacity up to the fullest. Once the maximum capacity is reached, capital must again be invested in the fixed equipment. Hence, the lower the fixed cost, the easier it is to adjust to changing demand and to reach the break-even point. The product produced by industries are demanded by consumers and other industries. Demand for industrial goods like pig iron, iron sheets, coil, for example, comes from the construction industry. Likewise, the textile machine tools industry produce tools for the textile industry, and the entire demand depends upon the health of the textile industry. Several such examples can be cited. An investor must analyze the condition of the feeder industry as well as the end user industry to assess the demand for the industrial goods. In case of consumer goods industry, a change in consumer preference, technological innovations, and substitute products affects the demand. The nature of competition is an essential factor that determines the demand for a particular product, its profitability, and the price of the scrip concerned. The supply may arise from indigenous producers and multinationals. For example, detergents produced by indigenous manufacturers and distributed locally at competitive prices. This poses a threat to the products made by a big company. Multinationals are also entering the field with sophisticated product processes and better quality products. The company's ability to withstand the competition locally and from the multinationals affect its earnings. If too many firms are present in the organized sector, the competition is severe. It will lead to a decline in the price of the product. The investor, before investing in the script of a company, should analyze the market share of the particular company's product and compare it with the top five companies. Government policies affect the very nature of the industry, and the effects differ from industry to industry. Tax subsidies and tax holidays are provided for export oriented products. The government regulates the size of production and the pricing of certain products. The sugar, fertilizer, and pharmaceutical industries are often affected by inconsistent government policies. Control and decontrol of sugar prices affect the profitability of sugar industry. In some cases, entry barriers are placed by the government. In the airline sector, private corporations are permitted to operate only the domestic flights. When selecting an industry, government policy regarding that particular industry should be carefully evaluated. Liberalization and delicensing have brought immense threat to existing domestic industries in several sectors. The analysis of the labor scenario in a particular industry is of very importance. The number of trade unions and their operating mode have an impact on labor productivity and modernization of the industry. The textile industry is known for its militant trade unions. If the trade unions are strong and strikes occur frequently, it will lead to a fall in production. In an industry of high fixed costs, the stoppage of production may lead to losses. When trade unions oppose the introduction of automation in the product market, the company may stand to lose owing to the high cost of production. An unhealthy labor relationship leads to loss of customers' goodwill as well. Skilled labor is needed for certain industries. In case of Indian labor market, even in IT and other industries, a skilled and well qualified labor is available at a cheaper rate. This is one of the many reasons attracting multinational to set up companies in India. For any industry to survive, the competition in the national and international markets, the product and production processes have to be technically competitive, which depends on R&D in the particular company or industry. Economies of scale and new markets can be obtained only through R&D. The percentage of expenditure on R&D should be studied diligently before making an investment. Pollution standards are very high and strict in the industrial sector. This is particularly so in the leather, chemical, and pharmaceutical industries that have significant industrial effluence. The strength of the industry and the competitiveness can be analyzed with help of SWOT and Porter's five forces model. So far, we discussed the factors that affects the industries and how to analyze these factors. You can analyze these factors, or you can analyze the strength of the industry and its competitiveness using the SWOT and Porter's five forces model. The students hope it is clear about the industry analysis, why the industry analysis is important, what is industry analysis, and the factors that are required to be analyzed. If you wanted to invest in a particular industry, first decide upon on which industry to invest, as the performance of the industry differs from industry to industry. So thanking for watching this. I thank all of you. for watching this video. Thank you.